Comparative financial statements. We all know that financial statements are the formal and original statements and presents the recorded financial information relating to any business concern. It means that financial statements are the recorded facts only. In order to have the optimum utilization of financial statements, we need to analyze them. If we want to analyze the liquidity, profitability, efficiency, solvency of the firm, we will have to undertake the financial statement analysis and thereby the interpretation of the same. If we want to estimate the future earnings, we will have to undertake the financial analysis along with the interpretation. Here, analysis means the rearrangement of the data that has been presented in the financial statements, whereas the interpretation means explaining the meaning of the data so organized. It means first of all we are going to prepare the financial statements, after that the analysis is done, and from analysis we interpret the desired results. Now what is financial statement analysis? According to John Mayer, financial statement analysis is a study of relationship among the various factors in a business as disclosed by a single set of the statements and a study of the trends of these factors as shown in the series of the statements. या तो हम सिंगल स्टेटमेंट से एनालिसिस कर सकते हैं या हम सीरीज ऑफ स्टेटमेंट्स की मदद से ये देख सकते हैं कि बिजनेस का ट्रेंड कहाँ है और बिजनेस से फ्यूचर एक्सपेक्टेशंस क्या हो सकती हैं. These analysis can be done on the basis of material used, on the basis of modus operandi, or on the basis of objectives of the analysis. So on the basis of material used, the analysis can be of two types: external analysis or internal analysis. External analysis is made by those who do not have direct access to the details of the company. So such analysis will have to depend upon the published financial statements. And this type of analysis is done by investors, creditors, or outside bodies. Internal analysis. It is conducted by those who have direct access to the books of the accounts and the related information. Such analysis is done by the executives themselves or by the government or by the any court agency who assume special power to inspect the books of the company. On the basis of modus operandi, the analysis can be horizontal analysis or vertical analysis. When the financial statements are reviewed for a number of years and the analysis is drawn, such type of analysis is known as horizontal analysis. It is also known as dynamic analysis and is based upon the data from year to year rather than for one period. So whenever we are going for analysis for a time span of more than 1 year, we are doing what? Horizontal analysis. Vertical analysis. When the financial statements are reviewed for one period only, it is known as vertical analysis. Now because we are reviewing the financial statements for one period only, it is also known as static analysis. On the basis of objectives, we can go for long-term analysis or the short-term analysis. Long-term analysis is made in order to study the long-term financial stability, the solvency, the liquidity as well as the profitability position of the business. So the purpose of making such analysis is to know whether in the long run the firm will be having the capacity to earn the money and to return the money. Short-term analysis is done in order to determine the short-term solvency, liquidity and stability of the company. The purpose of this analysis is to know whether in the short term the business concern will be in a position to repay its debt or not. All these analyses can be undertaken by the investors, bankers and lenders, suppliers, employees, management, regulatory bodies or different agencies depending upon the data with which they are analyzing the things. So all these people can go for various tools of financial statement analysis. It includes comparative financial statements, common size financial statements, trend analysis, average analysis, statement of changes in working capital, fund flow and cash flow analysis, or the ratio analysis. Now let us start with comparative financial statements. Comparative financial statements are based on the argument that financial data becomes more useful when we compare the similar data for the previous period or for the number of previous periods. जब हम एक डाटा को पिछले कुछ सालों के साथ कंपेयर करते हैं, then we can draw the useful conclusions. So, in order to study the financial and operating trends over a period of time, comparative financial statements are prepared. As we know that the financial statements consist of balance sheet and the income statement, so we can go for comparative balance sheets and comparative income statement. Comparative balance sheet shows the balances of the accounts on different dates, the extent to which there is increase or decrease between these 2 days, throwing a light on the trends and direction of the changes in the position over a period of time. It also helps in predicting the future position of the business. It facilitates interperiod, intra-firm और इंटर-फर्म comparisons. जब हम एक फर्म के लिए 2 या 2 से ज़्यादा सालों के डाटा को कंपेयर करते हैं और कंक्लूजन और इंटरफेसेस ड्रॉ करते हैं, हम क्या बनाते हैं? हम करते हैं इंटर पीरियड कंपैरिजन और इंट्रा फर्म कंपैरिजन. And when the financial statements of 2 or more firms are compared and analyzed, we are doing inter-firm comparisons. Comparative income statement shows the increase or decrease in the income and expenses over a period of time. It can be prepared in absolute terms or in the percentages term. Whenever we study the comparative income statement, we must analyze that what are the causes for change in sale, whether there is increase or decrease in the quantity of goods sold. So while studying the changes in the income statement, we must clearly focus upon what are the causes of the change in sales. अब sales में अगर changes हुई हैं तो क्यों हुई है? Whether there was increase or decrease in the quantity of the goods sold, or whether there is changes in the selling price of the goods, whether there is change in the quantity sold, as well as whether there is change in the cost of goods sold. So all these factors must be analyzed. And whenever we see that there is a change in cost of goods sold, we must see whether there is a change in direct expenses, or there is a change in purchases, or there is any change in inventory. If we see that gross profit over a period of time is increasing or decreasing, then we must analyze that this increase or decrease is due to which factor. Whether there was increase or decrease in sales, or whether there was increase or decrease in direct expenses, or whether there was increase or decrease in opening and closing stock. So all these factors must be analyzed to draw a useful conclusion. Let us understand these things by taking one example. In front of your screens, you can see the profit and loss accounts of ABC Company for the year ended 31st March 2009 and 31st March 2010. We have net sales, cost of goods sold, gross profits, operating expenses and net profits. And now we are to compute the percentage changes which have taken place from the year 2009 to 2010. तो सबसे पहले इन स्टेटमेंट्स को एनालाइज करने के लिए हमने ये सारा डेटा एक टेबल पे लिख लिया. सो इन फर्स्ट कॉलम वी हैव रिटन particulars, in second column the previous year that is 2009 and in third column the current year that is 2010. चौथा कॉलम हम बनाएंगे जिसमें हम लिखेंगे कि 2009 से 2010 तक क्या चेंजेस हुई, मीन्स द एब्सोल्यूट चेंजेस, एंड फिफ्थ कॉलम विल शो द परसेंटेज चेंजेस. सो लेट अस एनालाइज द नेट सेल्स. Net sales in 2009 were 24,25,000. 2010 में नेट सेल्स रिड्यूस हो गई 21,25,000 तक. It means the total absolute change in the net sales was 3 lakh. अगर हम इसको परसेंटेजेस टर्म में लिखें तो 3 lakh divided by 24,25,000 multiplied by 100 gives us 12%. तो सेल्स में 12% से रिडक्शन हुई है. Now let us see what happens to cost of goods sold. Cost of goods sold in the year 2009 were 13 lakh, whereas in the year 2010 were 12 lakh 25,000. So there has been a reduction in cost of goods sold by 75,000. In percentages term, the change is 75,000 divided by 13 lakh multiplied by 100 means 5%. And now let us study that what is the impact on gross profit because of reduction in sales and reduction in cost of goods sold. GP in the year 2009 was 11 lakh 25,000. In the year 2010, it was 9 lakh. So total gross profit reduction was 2 lakh 25,000 means 20%. In this case, when the sales of the company is reducing by 12%, gross profit is reduced by 20%. In order to analyze the net profit position, we will have to see what happened to the operating profits. Operating profit was reduced by 75,000, means 25% reduction, and net profits were 8,25,000 in the year 2009 and 6,75,000 in the year 2010, means the overall reduction of 1,50,000. In percentages term, the net profit was reduced by 18%. In this case, now the company was in a position to reduce its operating expenses by 25%, but even then, it could not help the reduction in the net profit. It means that the company is controlling the operating expenses, but company fails to control the downfall in the sales. So this is how the income statement is analyzed using comparative basis.